of this. So our topic, as was stated earlier, Investment 101, the essentials for change, essential in a changing economy. So Investment 101, the essential for a changing economy. And to say that we are living in trying times will certainly be an understatement. As was mentioned earlier in that fine prayer that was offered. We're dealing with COVID and all its variances, Delta and Omicron and whatever else is coming down the pike and hitting us. We're dealing with environmental catastrophes brought on primarily by global warming, if you believe that is the case indeed. Obviously, you know, in the news, we've seen what's happening in Tonga, the island of Tonga, the massive volcano that erupted and created havoc there. And of course, all that is happening and the impact those events are having on our economy. And I'm speaking, and the comments that I'm going to be given is in reference to the United States economy. I'm not quite sure where all of you are from or where you're located, but I hear Spanish Town mentioned, and I know Spanish Town is in Jamaica. So it's from the view of the United States economy. And so again, that's also something that I wanted to point out too. But of course, all of those events, they do have local implications, but also global implications. You know, there's this phrase that's been around for a while that we need to think locally, but we need to act globally. And certainly within the last 2 decades, we've seen where the world literally began to shrink, because not physically, but I guess if you ask certain astrophysicists, they will say that it's the opposite. The world is expanding, but the world is getting closer because of technology and again, you know, the internet and platforms like Zoom, where we can connect remotely from far distances. So in the area of economics, particularly in the United States, and again, the references are from the perspective of United States. We are living in what we call a 40-year inflation environment. We have never seen inflation this high in the United States in 40 years. And so this is something new. We're not quite where we would define it as hyperinflation, but when you're running inflation of 6%, it has tremendous implications. And we have known over the years that, as the saying goes, when the United States sneezes, the rest of the world catches a cold. And so we know that whatever is occurring here in the United States is going to create a ripple effect, just like that volcano off the coast of Tonga creates that ripple effect, that tsunami that again went ashore and created the massive destruction that they're experiencing there. We also been experiencing, particularly in the United States, what they call the supply chain backlog. And these are the backlogs that are occurring at our port of entry. And of course, those things are creating massive disruption in the way we do business and the way companies are doing business. It's impacting us as consumers because we cannot get the things that we purchased 6 months ago or even 8 months ago because they're still on those ships that's sitting out off the coast of Los Angeles, which normally will intake about 90% of all the goods that comes from Asia. We also live in an area where the prospect of high inflation is on the, not high inflation, high interest rate is on the horizon. And so right now, the Federal Reserve, which is our central bank in the United States, is thinking about raising interest rate as a way to curb the constant movement of increases in prices. We know also that from an economic perspective, that also has ramifications in terms of investments. And so those are some of the things that we're looking at. All of these realities and uncertainties have an impact on markets and investments, whether it is here or abroad. Many of us are also concerned about life after retirement, and that's a big one. How are we going to maintain a certain lifestyle after we leave the workforce? How much can I live on, right? Questions such as, will my retirement plan and in the United States, will my Social Security take care of all my needs? Will my 401k take care of my needs when I retire? Will my 403 plan be enough to live on? And for those of you who are not familiar with 403B plan, 403B plan is normally the plan that educators and not-for-profit institutions offer their employees. So whether or not those things are sufficient to live on is the question mark. A lot of financial analysts will tell you that post-retirement, you're going to need about 85% of your pre-retirement income in retirement. Now, let your head wrap around that for a second. 85% of what you used to earn while you were working, that's what you're going to need after you retire. I was talking to a colleague of mine last night, and this was the very topic we were talking about. Looking at the portfolio and to see whether or not what it is that how she desired to live after retirement, whether or not she could afford to live like that. And one of the conclusions we came up is that, well, some of us just going to have to live a little bit less lavishly, right? We might have to live what they call the minimalist lifestyle, where we sell the big house and we sell the big cars and we get one of those tiny homes, right? And we live that way. Hopefully all of you are debt-free and will remain debt-free, and everything is paid off, and so that your cost, your living cost is manageable come retirement. But if it's not, then there are some things that obviously we can do. So with respect to investment and securing that nest egg, separate from and supplemental to your pension, if you have a pension coming. A lot of companies don't offer pension anymore. That's a relic of the past. But most companies will still offer 401k and certainly the 403k. But if you have neither one of those, or maybe you have one or two, or maybe none of those, again, it is never too late to invest. Arguably, it is better to start early, and through the power of what we call compounding and wise choices, you could be sitting pretty as you face the latter years in your life as you see your money grow. Now, if you're already in the latter years of your life, then there are some other things that you can consider. The second point I must make is that all forms of investment comes with a certain level of risk. And I need to emphasize that again, all forms of investment comes with a certain level of risk. In fact, the higher the risk, the greater the reward of payoff. No risk, no reward. And that is key. It's almost like saying that, if I stay in my house, I'm safe. But if I go out, I'm taking a risk. Well, you can stay in your house, but sometimes even staying in your house is also risky because things can happen. But yeah, you can stay in your house and you're fine. But what exactly can you accomplish just staying in your house? I know during the COVID, and we're still in the COVID, the lockdown, a lot of people really were frustrated because they couldn't go out as they were accustomed to. And so that created a lot of what they call cabin fever, right? But no risk, no reward. And so there are also thousands of financial assets or instruments on the market to meet the needs of a diverse body or clientele. So there is something for you. So before you venture out, or if you're already in the market, deeper in, if you're already an investor, you need to determine from the outset, what is your short-term and what is your long-term financial needs? And then you have to figure out, you don't have to figure this out by yourself, by the way, but you can do some independent research to find out the appropriate financial assets or instrument that will meet those needs. So in essence, what do you need come post-retirement to live the lifestyle that you desire? A lot of my colleagues, we believe in doing mission after we decide to retire. Well, we have to decide, okay, so what type of mission we want to be in and how costly that will be. So if we are planning on traveling, that's going to be pretty costly. If we're planning on giving a substantial percentage of our wealth to ministry, well, how much of that and at what quantity are we going to give away? And so we need to figure that out, and you need to figure that out if that's the direction that you're going in. So you have to find out again what it is that you need. What my financial needs are going to be when I retire. Now, when we talk about financial needs and investment, one of the things that we have to look at is what we call short-term and long-term. Now, there are two ways of looking at short-term and long-term. For a lot of people, short-term is anything less than a year or a time frame less than a year, and long-term is normally 5 years and over, somewheres around there, give and take. We have to look at that. We have to also look at the fact that the longer you invest in a financial instrument, the greater the reward is going to be over an extended period of time. So in essence, what I'm suggesting is that you have to be in the game for the long haul. There are individuals who are investors and they basically invest short-term assets, and that's fine. But those are short-term gains. I have been an investor now for over 30 plus years, and I do have a diverse portfolio. And when I say diverse, it has stocks, it has bonds, it has some commodities in there. And so it's pretty diversified. But over the years, I've experienced a lot of ups and a lot of downs. However, I am in it for the long haul, and hopefully when I need what I want in terms of funds, it will be there when I need it. And I know within the Christian environment, there is always this hesitancy, particularly to get into investment, because from a Christian perspective, and this is the Christian worldview now, we view the market as a form of gambling. And again, I don't know how this body feels about that, but if you present a definition of risk, then gamble will be part of it, because whenever you take risk, you're taking a gamble. And so that's for a separate conversation. But I just wanted to point that out, that is a concern for a body like this. And I know for sure within mainstream Adventism, we frown on individuals, or we even frown on the NAD or the World Church getting involved in the markets. Parenthetically speaking, I do have a retirement plan with with the NAD, and it's actually growing faster than some of my assets in my portfolio, and I'm really pleased with that. And so again, you figure, all right. So again, you have to be in there for the long haul. There are absolutely no guarantees at all. It's risky, except to say, as I say, there's no guarantee except to say that the only guarantees is that you have to pay taxes and you will die, right? That's always the common refrain when we talk about what are the things that are absolute in the world. So the market, again, is not for the faint at heart. High risk, high rewards; low risk, low rewards. You also need to be aware, and I'll just throw this in, you always need to be aware of individuals who will tell you that, hey, you know, I have an investment option that will net you, you know, 15, 20, 25, 30%. Normally those are snake oil salesmen, and they're selling you something that is not real. So always be aware of you know, those more than believable returns. More than believable returns. Okay, so if you're going to enter the investment world, what I would suggest you do is to start slow and safe to test the water. Start slow, start safe to test the water. Make sure that what you are going to invest, you can walk away from it. And when you walk away, you will not place you or your family in dire financial strait as a result of your investment. And that is so important. In essence, you should only use your disposable income to invest. So if you lose it, you're not going to weep, and you're not going to literally die. Okay, not physically, but you know, mentally. You need to be able to walk away. So in other words, don't risk the house and all the kids and the cars and the kids. Be wise. Be wise when you decide to invest. I also need to mention too is that sometimes in our circles, you have a lot of snake oil salesmen. And there are individuals who are going to come to you because they know that you are trusting, and they're going to tell you, oh, we need to invest. You know, you can invest in this and you can invest in that. Just be a little cautious on that, because quite often in our circles, people are taken advantage of and end up losing a lot of money. So just kind of beware of you know, who you are trusting in as it relates to handling your money. Okay, so why invest? Why invest? And we're probably going to run over a little bit here, because I noticed it's like 7:57. How much time leeway do I have here, Dr. Baldwin?
Well, it's typically for half an hour, but how much more time would you need? Another 10 minutes? I think I need
about maybe 10, 15 minutes.
15 minutes, okay. Yeah. And then there'll be a Q&A session.
Yeah.
Okay.
Okay, good. So why do we invest? Ultimately, we invest to earn money, all right? We invest to earn money. Quite often too, the word investment is loosely used in non-financial ways. So people say, you know, I'm going to invest in a car. I'm going to invest in this. I'm going to invest in that. It is only an investment when you can earn a return on it. In other words, you can make money off of it. So an example would be if you buy a car is not an investment. A car is a consumption. However, if you turn that car into a taxi cab or Uber, then it becomes an investment because you're making money from that car. So that's a very important distinction as we talk about investment. So we invest ultimately to earn money. So the amount of money you earn depends primarily on three things, or three factors. Two of those we have control over, and the other one we certainly don't have any control over. So the first one is the investment performance. And we normally phrase investment performance in terms of portfolio. The portfolio just the combination of investment assets that we have in our possession, or the combination of investment assets that we purchase. So you cannot control investment performance. That is why all investment involves some degree of risk. So the main cause of risk, particularly in the market, is fluctuations. And fluctuation has to do with uncertainties. Unknown. We don't know. We don't know what the COVID virus is going to do two weeks from now. We don't know what natural disasters is going to impact us 2 weeks from now, or even tomorrow. And so those create quivers in the market. So uncertainties, and people don't like uncertainties, particularly in the market. The market likes certainty. And so whenever there's uncertainty, there's a lot of jitters in the market. And when I say jitters, people start to sell their stocks. And then others buy. So that's why it's a market, selling, buy and sell. So those fluctuations on your investment or your return, because again, uncertainty. The second factor is the amount that you invest, obviously. So you earn through compounding. Compounding is just your money, making money over and over and over and over again throughout the years. So compounding is when your investment earnings generate their own earnings. So you invest $10, you get 5% interest. That translate into, again, more money you earn, and so on and so forth. So it just keeps rolling over. And just like a snowball, if you roll it down a hill, it gathers more snow, and before you know it, that snowball becomes a big avalanche. Okay, so if you contribute more, obviously in your investments, you have more to generate in terms of income. And the final factor is, when you invest, you need to start early. I always encourage my students in my classes, if they're thinking of investing, they need to start thinking now, because in the process of compounding, by the time they reach our age, and I see quite a few of us are probably in the same age group, by the time they reach our age, they will accumulate enough money to retire literally when they reach 50. Okay, so start early, start now. If you're serious about your financial future and security, you need to invest, and there are many ways to go about it. And so if you're thinking about it, or if you're in the market already, this would be just a refresher. You can start with your local banker. Your local bank is a good place to start. Your local banker normally is certified as a financial advisor or planner. And so they can introduce you to the different types of instruments or assets that are there. And by the way, you don't need a whole lot of money to start investing. A lot of times people think that you need a whole bag of money to start investing. You don't. You start small and slow. And then when you get the hang of it, and you get into the swing of things, then you can expand. The other place that you can start is find a trusted financial advisor and planner. And those individuals are certified to provide you guidance in terms of managing your money. The third thing you can do is take matters into your own hands and log on to one of the many investment sites, and basically, again, start small but smart. Start small, but start small. Some of those trusted, and I use the word trusted because there are a plethora of sites out there, and some of them are there to swindle your money. These are some of the more trusted sites that are out there. There is Fidelity Investment. That's a particular great one for beginners. if you live in the States, you probably have seen ads for TD Ameritrade. That's a really good site to log on to if you want to try your hands with online investing. You've probably heard of E-Trade also. And E-Trade is another trusted site. So other sites that are less familiar but are trusted, Tastyworks, Interactive Brokers, and Merrill Lynch. And most of your big financial houses, they do have an online component that they use and offer and make available to their clients. Two other ones that are, again, less known, but they're really big in terms of online investment platform would be Bull and Robinhood. So those are your big trusted sites if you want to, again, venture out and try your hands at investing. Now, in terms of instruments, so these are the things that you would actually invest in that will provide you with a return. Stocks, obviously, most of you are familiar with stocks, and stocks are basically equity in a company. And equity just means that you're part owner of the company. Small owner, but you're still part owner. There's also what we call EFT. Those are exchange traded funds. And these are all funds that are made up of a collection of small assets. And those assets could be stocks, they could be bonds, they could be commodities. It's just what we call a market basket of different assets. Similar to when you go to the market and you pick up apples and pears and oranges and, guava, whatever it is. It's just a diverse basket of financial assets. And the reason why they offer you a basket is that it kind of insulates you, if I can use that word, insulates you in many ways in terms of losses. So if you have one financial asset that devalued, then another one might increase in value and it offsets. And so that's why we go with the exchange traded funds, or the ETF. You're probably familiar with mutual funds, and mutual funds are typically purchased directly from a company that manages the fund. So for instance, a lot of 401k are actually a form of mutual funds. So they're made up, once again, of a market basket of assets, and it's diversified. So it's a diversified investor portfolio. Like I said, your 401k and many of your 403 are forms of mutual funds. And then there's another one that is pretty popular. We call it the low cost index fund. And that is a fund, gets complicated, but that's a fund that's pegged to the S&P 500 in United States. That's the Standards and Poor 500. So it's index, which means that it's when it's pegged, it's connected to the growth of the S&P. So when the S&P grows, your index grows. When it doesn't grow, your index doesn't grow. Real estate is also a very lucrative one, both commercial and private real estate, depending on where you live. It's always a good investment there. Some markets are hot and some markets are not. Your money market mutual funds, those are what we call short-term assets that are designed to be easily liquidated, which means that you can sell them real easily and get your money. And they're usually purchased by a company. And then you have your government treasury bills, your bonds, and your notes. And those are the most secure. However, because they're so low risk, they don't offer you lucrative returns. Again, low risk, low return. And the government bonds, they're backed by the United States government. And those are in essence, you're lending the government money and you're earning an interest. on it. So for instance, your Treasury bills are what we call short-term loans. It can be 4 months, 8 months, 13 months, 22 months, or 52 weeks. So you get a rapid return, and you can buy those at a, what we call $1,000 face value. So $1,000 and whatever the interest rate is, within 4 months or 8 months, whenever the maturity date that you choose, you can earn a pretty decent return. Not exorbitant, but decent return. Some things that you might be familiar with, certificates of deposits. You probably have heard that before. They offer a slightly higher interest rate than your regular savings account. And again, these are funds, however, that will be locked in for 3 months to 5 years. So you won't have access to it. However, there are some certificate of deposit that you'll have access to, that you can make withdrawal. So again, here go my light. So that you can make withdrawal to periodically. And so again, whatever your needs are, your financial advisor will be able to kind of tailor something that meets your individual needs. One of the new things that's happening, and I'm watching my clock, 5 more minutes. One of the things that is also pretty popular in the market is online bank accounts. They're not as risky as they sound. So they do offer high yield savings accounts online. And again, you can look into it. It's going to offer you certainly higher than if you go to your local bank and open a savings account. Right now, the interest that you get on a savings account is it's almost zero. So it will be equivalent to you keeping your money under your mattress, right? There's no return there. So you might want to think about that. I was also asked to talk about Bitcoins or cryptocurrencies. There's been a renewed fascination with cryptocurrencies over the years, and there are a number of different ones. There's Bitcoins, the most popular, obviously. There's the Litecoins. Let's see. There's Bitcoins Cash, and there's one called Dogecoin. So those are the more popular cryptocurrencies, and these are cryptocurrencies. These are all electronic encrypted currencies that are actually favored by certain individuals because they are not traceable in terms of transactions. So there's a level of anonymity, but they're being used more often than not in regular transactions. The problem with crypto is that they're pretty volatile and they can rise and fall in value in a split second. Right now, Bitcoins are trading. Well, actually, a week ago, the value of Bitcoins actually went down by 45%. That's how volatile they are. But you can buy cryptocurrency using debit cards. You can buy them using Venmo accounts or bank accounts. They're currently I think they're trading now for. So the last time I checked, I think they were trading one Bitcoin. It's an actual coin. One Bitcoin is trading for $36,600, somewhere around it. $36,600. They went up a couple of years ago to almost $60,000. And so if you were in the market earlier, literally you would be a Bitcoin billionaire by now. I think Tesla, Elon Musk is a big investor in Bitcoins, and I believe you can actually buy a Tesla with Bitcoins. I know Starbucks, you can purchase Starbucks with Bitcoins, and a couple other reputable establishment uses Bitcoins. But the thing you need to know is that they're pretty risky. It's a pretty risky venture. You can buy Bitcoins at a couple of different places. They call them exchanges. So you can find exchanges. So you can places like Coinbase, Gemini, Binance. I guess they they copied that name after Beyonce, I guess. I guess somebody, whoever created that exchange kind of maybe like Beyonce or something, because the name is definitely similar to Beyonce. But if you decide that cryptocurrency is something that is intriguing and it's worth the risk, whenever you go on the exchange, make sure that exchange has what they call a wallet, a built-in wallet. The wallet is important because the wallet is where you're going to store the Bitcoin that you purchase. It's very important because, again, if you don't have a wallet, you cannot transfer that Bitcoin to another platform. So, for instance, if you buy your Bitcoins using PayPal or Robinhood or Venmo, you cannot withdraw or transfer from that platform. So it has to stay there, which is a bummer. Whenever you purchase Bitcoin, the transaction fees can run up pretty high, anywhere from 2 to 4%, depending on the card that you use. Now, the good thing about Bitcoin is that if you want a full coin, you have to obviously come up with $36,000. However, you can buy a fraction of Bitcoin. So you don't have to come up with $36,000. You can buy purchase $6,000 worth, a fraction, and you would only own a fraction. So in your wallet on the exchange, it will tell you what fraction of that Bitcoin you have. Now, if that Bitcoin appreciates in value, it will be reflected in your wallet, and you can sell it and obviously recoup the real value, and put it in your account. Okay. All right. It's 8:16. I'm going to stop there, and if anyone have any questions, I will attempt to answer.